Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Tuesday, February 21st, 2023. It's 11:43 a.m. Eastern Times. I'm starting the video. This is a abbreviated trading week for those of you outside the states. We had the markets were closed yesterday in observance of President's Day, so that's why we didn't, or I didn't get any post out to you. Took the day off, so we're back. Up and running, 4-day trading week, and I'm going to go over, start as I usually do with the equity markets, and I'll talk both short and long-term perspective, and short-term perspective or short-term, very near-term outlook. I just covered and reversed shorts. I don't have a hard buy signal. If you recall, let me just loop back, and I'll get back to this 5-minute chart. Last week, we were dancing on this support right here, and I said I expected a tradable bounce, quick bounce right there. That's where we were on Friday. That was 12,226, and we got that bounce. In fact, I laid out a target for you on the 15-minute chart of this downtrend line. I said that would be your most likely bounce target. Wasn't looking for much, and then go on to break that, and that's what happened. So there's a little bounce trade to be made on last week, and right now we could bounce. Again, we're down about 1.3%, almost 2% on the Qs. We could certainly fall more. Again, I'm not making a screaming case to go long. I want to reiterate what I said last week. Swing trend traders, the RR still remains favorable to be short. I'll get to the long-term charts in a second, but very near term, the one I just started out with was a 5-minute chart of QQQ. Active trading usually, will go anywhere from the 1-minute charts out to the 5, 15, 60. I like to look at various time frames, various indexes, but you can see we're building some pretty decent divergences, and just as we were, you can see it there on the 5-minute chart. Here's a 60-minute chart of QQQ as well. Remember, bigger picture, or at least intermediate term, was we broke that primary trend line right there off the early January lows, back tested it a couple times, and then broke the secondary minor trend line there, and that gave us a sell signal that's currently in play. But as you can see, I pointed out recently, this is the overbought range right here, or oversold. That's the zero line right there on the PPO. But you get down here in the PPO, and this is often where you'll bounce during larger uptrends. And then you can see down here we're also at the oversold. We're at the 30 oversold level on the RSI, but in a downtrend, this is where you usually come down to. So if this is the start of a larger correction, we could easily carry lower. And again, at best, maybe a little quick bounce trade. Maybe not. One thing about this market, and I'm going to get again to the long-term charts in a second, and this is not just the equity markets. It seems to be about most commodities, everything else. A lot of things are, once the trend, whether it's a intermediate term downtrend or an intermediate term uptrend, trend lasting weeks to even months, once it's over, there's often a pretty quick reversal. They don't let the longs out after a rally, and they don't let it make it easy for the shorts to get in. They tend to reverse pretty hard, so just keep that in mind. And again, let me once again reiterate, longer term swing and trend traders, the RR, even though we've moved down quite a bit, we've already dropped from the recent highs just in the last week or so, about 5.5% on QQQ. I still think the risk reward is not favorable for longs, and I'm talking again to this multi-week, multi-month swing and trend traders. I think upside is limited, even if we happen to rally on up and get that marginal new high scenario I've been talking about, which may or may not happen. Again, it's limited compared to the downside potential here in the market. So let me get back to the charts and just show you. This is what it looks like on the hourly chart, 60-minute chart. One of my favorite swing trading time frames, as you most likely know. There was our primary uptrend line, again off the early January lows. It was also a divergent low. Case was made to be long there, especially once we broke out of that trading range. I call it the Christmas trading range. Rallied up, and that's the same chart I just covered on QQQ. The breakdown right there, back tested a couple times and broke the minor channel. But here's what we're looking at on a shorter term perspective. You have that same downtrend line I highlighted on Friday is a likely bounce target. I'm going to zoom in a little tighter here. I just showed it to you on the 15-minute chart, but here's how it looks on the 60-minute chart. We have a downtrend line right here. You have, at this point in time, positive divergence because you're making, you can see I have on the NQ NASDAQ 100 futures, which we're looking at here on the 60-minute chart. My oversold level is right here. It's about 2263, not the default 30 level that most charting platforms will give you. As you can see, that is typically when you get that oversold, and that's where we were. That's exactly what I highlighted on Friday, and there, we got a bounce. But this may be the beginning of a longer downtrend. In a strong uptrend, you hit it and you usually don't come back and hit it again for a while. You have a pretty nice leg up. And as I said on Friday, you know, we could stay at that level, stay overbought for an extended period of time. So again, the bounce was small, was certainly tradable for an active trader, but here we are again. So now it's a double tag of that level, which does something else. It's not just the fact that we're now again oversold at levels that typically, not always, sometimes you get deeper, but typically produce a rally, a tradable bounce. But you also have positive divergence. You can see here the PPO at this point is making a higher low versus that previous low, and the RSI, which I was just talking on a minute ago, has made an equal low, and that's also positive divergence. When prices are making lower lows and your indicators are making either equal or higher lows, that's positive divergence. So positive divergence, I always say, is not a buy signal. I prefer to see it at support. It's a little fuzzy, and that's just minor support, but that's where I have the next support there at 12.057. It also aligns with support on QQQ. Let me jump over to that. So I could see a little bit more downside and maybe give us a 3% down day. We're at 1.84% down right now. Here, this is a QQQ 60-minute chart. I'm going to measure it out and see what it would look like. So there we are, down on the day, 1.8% right there. And if we drop down, there's some support not far below. That'd be about a 2.5% down day. I actually haven't updated this level in a while. I have to play around. Really not great support here on the 60, but on the daily, we do have good support. Remember this box here. Let me go to my clean board. That red box highlighted way back here at the low so far, the bear market lows back in mid-October. I highlighted this as my most likely bounce target zone, where the rally would most likely take us, anywhere from the bottom to the top of that zone. Highlighted objective shorting ops every time we hit the bottom. We hit the midpoint there in the pre-market session that day, and then we traded that down. Then we got long here after the Christmas trading range, traded the breakout, and again, it's what's capped the very top of the most likely bounce target zone, which is a resistance zone, is where we've stopped so far. Now, where I'm going is we've now pulled back to the bottom, and the way it works is resistance, once broken, becomes support. So, like I said, this is a pretty key level. It is possible. Bear markets tend to be pretty vicious to the bulls, to the dip buyers, to the optimists that want to believe it's over every time you have a bear market, a bear market rally like this one. And you know, the deeper the bear market goes, usually the more powerful. I don't see yet what feels like that, you know, an Elliott wave, 5-wave count, P3, the third wave. You have an up, you know, wave one up. I'm sorry, wave one down. Wave 2 counter trend. Wave 3 is the most impulsive and powerful wave. Then 4, and then 5, and then it's over. Or even if you don't use the Elliott wave, I'm familiar with it, but it's just too subjective to revisions, so I don't always incorporate, or usually don't incorporate it in my trading. But they do have that consistency, and bear markets and even bull market trends have that powerful wave. Where, you know, I call it point of recognition, where the masses kind of realize what the situation really is. And so, but again, if you take a look at that was the first bear market rally, and it got sold into pretty impulsively. You didn't really have a chance. If you missed the turn, The dip buyers that thought it was over kept buying, buying, buying. Then they start puking it up here, realizing their stops are hit, or they just can't take the pain, or their broker gives them a margin call. And remember, the vast majority of market participants, vast majority, are always long, especially on the indexes. Yes, you can have a heavily shorted individual stock like a GameStop or something else. Those are unique situations where big hedge funds take position, but you're never going to have, over 50% short interest in the S&P 500. Because the majority of market participants inherently are bullish and typically only trade on the long side. And so in bear markets, that's why you have these powerful drops and powerful rallies too. It's a combination of short covering, which certainly does have an impact on the indexes, especially in a heavily shorted market, and then also the hopium trade, where those that think it's over, and maybe it's over, and we'll see. But so far, this doesn't have. Well, we'll see. Let's not speak to whether it's over or not. Again, I'm kind of I always share my long-term views, but I don't. I position and make money on what's going to happen today, tomorrow, next week. Even if I believe, which I still do, that the market's going to do this over time. To be short right here and to be short right here and short right here, which we weren't, we were long, is painful, and will often end up stopping you out or just causing you to give up. So again, this is what this site's all about. I don't have to really repeat that. It's about swing trading. And I will speak to investors and trend traders and 401k type monies, and that's what I've spoken to there. So once again, you have just to highlight also some of the recent bearish developments that support the case, have supported the case to be short recently, were those bearish PPO crossovers. And again, that was finalized last week, as I mentioned in QQQ. You had the rarely seen in a bear market, that is, rarely seen overbought levels, readings. That's over that red line there, which is a 70 level. In a bull market, overbought tends to become more overbought, meaning get much above 70 or stay overbought for an extended period of time. But in a bear market, it's usually one and done. And so if you believe that we're in a bear market with more downside to come, like I do, then you have to respect that and or position when you see things like that. So that's that. That's kind of longer term perspective. I think there's a decent chance that we will ultimately, whether it's very soon or later, fail the fall back below the 200 days, fall back below those trend lines. I think this whole thing will be a fake out. But like I said, the markets have a good amount of support just below, and again, right now we're at that. If you look here, 1, 2, forget about all the others. There's quite a few reactions in the past there, but just recently, major reaction highs. We consolidated around it a while, then had a breakout candle right there, and we're back testing. We already back tested it once, or close enough, and this is still, it's more of a range, and so that's it. So yeah, I have increasing check marks, including the bearish PPO crossovers for the bearish case. And well, let's just see what happens. I may flip out and just, I put some pretty tight stops under those longs that I reversed to, trying to just game a little quick bounce based on the 5-minute charts and these little wedges. And watch, by the way, watch that trend line. If you want to just stay short and ride it down, we may go through there. We could easily burn through the divergences. That quite often happens. But either way, if you are short and you're going to ride it down, stick with it, then just watch a break of that trend line. Maybe set a stop somewhat above there, maybe allow for a 30 or 60 minute candlestick close above it, because if they pop that, that's probably where they're going to rally it. And again, they're coming up on major support. So let me just spin this one other way, or say this one other way. The RR, the risk reward for shorting right now, is not very favorable because we are coming up on support. It was favorable, to go home short over the weekend after the bounce, but it's no longer very favorable in my opinion. So that's it. I think I've dissected QQQ. Oh no, let me show you the other ones, then I'll move on. Remember, QQQ is one index. It is my go-to preferred index to trade. You get more bang for your buck if you're right on what the market's going to do, go up or down. the Nasdaq 100 typically goes up more than the S&P 500, and when the market falls, it typically falls more, just because of higher beta, the higher, more tech stocks, less steady Eddie dividend paying stocks like the S&P 500 has. All right, so here is the S&P 500 via the futures. Yes, there's a trend line that I've been calling us down to. I still think we're going to. It's just a matter of how do we get there. Are we going to go straight there? Possible. It's not that much farther below. Let me just measure it out for you real quick and for my own good too. It's only about that's about 1.25%, 1.2%, so not too far below. But like I said, we're getting stretched. We have positive divergences, potential divergences, not confirmed. You need to see the PPO roll back up, turn back up here, and effectively put in a higher low. I like to see a higher trough, and then you have a higher low, and that confirms it. Now, if we go much lower, you can see here we have about equal lows on the RSI, just like on QQQ. We'll burn through that. We won't have that 60-minute divergence. We could have it, well, we'll see. Well, let's see if when we get there. And there's a comparable downtrend line right there on ES. So remember, we took out this minor trend line last week, and then I think that's where we're at on Friday, and that's where the case was to play that bounce trade. There's the bounce that we got on Friday, and then here's where we're at now. All right, so again, getting close. Downside is minimal, anywhere from where we're at now to about 1.2, maybe call it 1.5%. You know, if you get a little meltdown type move, sometimes you get a momentum fueled overshoot, which means you briefly take out the support level only to snap back above it, usually on that candle or the following 60-minute candle. And then let me show you SPY, which is the S&P 500 ETF. 60-minute chart. Yeah, trend line comes in. Yeah, same level. This is that same trend line right here. And still where I think we're going. It's just a matter of we're going to do this first, or even this, and then get there, or are we just going to pop it and go down? You know, they're selling it pretty hard today. We do not, let me repeat, do not have positive divergence on the 60-minute chart of SPY. Let me see if it's on QQQ. No, and we don't have it on QQQ either. And that's big to me as well. I really, when I see 60-minute positive divergences on SPY and QQQ as well as the futures, that's where I usually look to position for a swing up. Had we had that, then that would strengthen the case for that marginal new high, but we do not now. We've burned through that potential divergence. So to me, as of today, it lessens the chance of that marginal new high scenario that I've talked about. All right, last but not least on the indexes, IWM, these are the small caps, Russell 2000, one of my favorite indexes to trade as well. You get more juice than the S&P 500. These are higher growth, smaller companies with higher growth rates. So when things are good, they go up faster or more than the S&P 500. And likewise, when things are not so good, they tend to fall more. Uptrend line, you have a few reactions here, so we need to validate it. So I'm going to put a question mark. But what we also have, see this purple line is a back test of the primary downtrend line. I'm going to need to go, I'm talking about this one right here, but I'm going to zoom out to the daily chart and show it to you. And big level there, about 189.20 right there. That is, if you look at all these reactions, major reaction high there, there, and then we broke out. And we're back testing now. So this I also covered in reverse RTY today. That's the small cap futures. And here's what it looks like on the daily chart right here. There you go. It's a little bit of a busy board. Let me see if I have a cleaner board. I do not. Do I? Nope. Bunch of fib boards. All right. I'm just going to draw it for you. It's right here. This purple line starts right here. That's the downtrend line I'm referring to. This is the larger, more significant downtrend line right there, and there's your uptrend line. So this is where I think at least these small caps are going down here. It's just a matter of, are they going to bounce off this one at first? There's a good chance. Again, remember, the turns in bear markets can be pretty powerful, like that one right there, like that one right there, like that one right there, even that one more recently. And this is a turn right here. So we could go on down there, but we do have quite a bit of good support. This level, I had it color-coded 189.50. I just showed it to you on the 60-minute chart. That was a big resistance level. A lot of reactions from above. We traded around it, had a bunch of reactions around it there, had a reaction high there, there, broke out, and we're simply back testing it. So there is a confluence of pretty important resistance, but the way it works is resistance is a resistance. I'm sorry, let me back up. Support right now. Support is support unless broken. So we're at that support now, maybe a hair below, but on that trend line. And so, the small caps either need to rally here or they're probably going to break it and go on down. They do have the 200 days and a bunch of stuff underneath. So that was that uptrend line. And let me just pull up RTY. RTY. This is these are the Russell 2000 small cap futures right here. That's that potential uptrend line I just showed you. You had about 4 reactions right there, so it's still kind of questionable because we need to get a reaction here to help validate it. This is really a cluster of reactions I like to show. So just a potential support level there. And if that gets taken out, here's that larger, more significant uptrend line I showed you on the IWM right there, and that would be, should we just keep heading down here and the buyers fail to step in, that's going to be a good 5% plus until we get down to that level there. All right, enough on that. Let me show you a couple other trade ideas, trade updates. Mentioned the metals recently, had those divergences on silver and gold. So far, this is SI silver futures, the hourly candlesticks, 60-minute candles. It was that wedge, that little breakout back test, and they're coming off that divergent low, and it's still up. It was up a little bit more today, but still up a respectable 0.62% on silver futures, coming up close to that 22.047 level. And again, I'm kind of coin toss odds. I told you the RR, we caught most of this short. We got out of longs, caught most of the short on the way down on the miners and the metals. And to me, it's more of the risk reward. There may be a little more downside, but I'm still longer term bullish. And right now these 60-minute divergences are playing out, and I think there's a good chance they're going to play out a little bit more. Hard to say with the highest degree of confidence. And again, it's also could be the end of the correction. I made that case last week. I'm not going to go too much in detail because I spent a lot of time on the equity markets. But gold, same thing. GC gold futures, downtrend line, bullish falling wedge, positive divergences, and in a bull trend, that's often what ends a correction. So I think there's a very good chance that the end may be over, the correction. If not, there's your next support, a good support level where I'd be a buyer of gold, especially if the chart's still confirmed. What does that mean? Maybe there's we go down quickly, flush out, and still put in a divergent low, just a larger divergent low. So, but I'd like to be long because I don't want to miss that turn. So I'd rather start here, start a position, which I've had, and add to it if we get down there. And then worry if charts fall apart or something else changes. And of course, I've been looking at the dollar and the euro. Then I'll make a decision whether to change my outlook. But when I remain intermediate and longer term bullish, or more so longer term bullish on metals, I look to, I will short the pullbacks when I think they're going to be tradable, as this one was. But then I'll look to start either a hard buy, but usually a scale in, to re-enter those long positions once I've closed out the shorts. And so that's what this is, more of a scale in zone. And if we just continue up, continue to scale that back in as well, add to those positions. And that includes GDX. I told you I'll do an update soon on the individual mining stocks. I've been covering GDX. This was T1 pullback trade right here, that $30 level, we hit that, and then T2 was right there, and you can see we're right there. You have a little downtrend line. Let me clean it up a bit right there. Let's just put it like that, and we're right on that trend line. So 60-minute chart says we could pop. These lines have drifted. Sometimes I get that on this program. Don't know why. I call it trend line drift. They just kind of move around a little bit, even if I haven't changed the time frame. But there it is. So we can pop that. We could run in the miners here. And throughout, I think palladium to you last week is my top pick for the metals. PA, palladium futures, and then PALL. This is PA. And it continues to walk up. So if you want to keep a tight stop, if you took this one last week, there's a trend line right there that's starting to form. We have enough reactions. You could have a stop somewhat below there as a relatively tight stop. I'm still targeting a move back up to this trend line here, and that's where I think I highlighted it last week. So we've been stair stepping higher, and we still have, assuming that that target is hit, still would be another about 5, 6, almost 6%. Again, depending if and when we get there. 6% if we hit it soon. If it took a while, it'd be 5%. And if you don't trade futures and you like ETFs, PALL is your palladium ETF, and that's 60-minute chart. I'm just showing you the same downtrend line right there, a comparable downtrend line. And I always say this, even if you trade only ETFs, keep an eye on the futures, because a lot of times the pros, especially niche things, not many individual investors. I don't know the last time you were at a cocktail party or hanging out with friends and you guys and people were talking about trading palladium or lean hogs, these odd obscure things that I trade. Often the pros are using futures on those. So and the takeaway is, if you're not watching this and you're in PALL and it gets to about right here, a little shy of the trend line, the downtrend line, but then reverses, well, that's often because palladium futures hit that level and the sellers stepped in. So that's why I like to watch both the ETFs as well as the futures contracts, even if I'm only trading one or the other. Oh, one more thing. Okay, I'll wrap this video up so it's not super long, but forever and a day I've been saying how that Bitcoin, basically it's a leverage play on the stock market. It's been a complete risk on asset, meaning when the stock market's rallying, Bitcoin rallies. When the stock market's going down, Bitcoin's been going down. That's been in almost lockstep since the bear market started well over a year ago now. And it's an easy trade, so it's a volatile trade, and I can't say it often enough. I have a position size calculator created. It's on the site under resources. Go to the top menu there and go to the tool under the resources tab. You'll find it. And just know that Bitcoin is going to tends to move, and as long as that correlation stays in sync with the market, but it goes up and down a lot more than the stock market. So you have to temper down your position size quite a bit. Take a fraction of what you trade in the S&P 500, for example, and based on the my outlook for the market. I think it's a good time to be short crypto. We've had a heck of a rally, and in a vacuum, I might say, if I couldn't see the charts of crypto, I might be short now just based on what I'm seeing in the stock market. But the good thing is I can see the charts of crypto, and what I see here is a big divergent high. Look at that negative divergence right there. And there was an uptrend line, we broke it. So that's a sell signal, and it's fairly recent. So where do we go? There'll be stops along the way. One right there, I think. I'll give you that level. But if the stock market has run its course and this bear market rally is over, the bear market rally off the October lows, or even if the January rally, the rally since the beginning of the year, is going to see more fading, even if we don't take out the October lows. So let's just not even get that far ahead. I think we will, but this is still a lot of meat on the bone for this one. That's about 5% to that first target. Second target is about 8%. Third target down there is about 15.5. And if bigger picture, if the stock market has finished a bear market rally and it's going to go down and test or take out the October lows, then there's just a lot of downside potential in crypto, which is pretty much 2 years in a bear market, clearly in a bear market. And this was a bear market rally, and it doesn't look like much here, but it was a 65% or so rally. So, and again, it coincided with the stock market rally. So there it is. I think it's favorable to be short crypto. That's when I zoom back into that 1 month. That's BTC. That's the actual crypto itself. I trade the futures, BRR. About to roll to the March. The Februarys are still trading. That's what I'm in, but let me grab that. That's the March contract there. Here's the Februarys right here. They're gonna roll over soon. There's your wedge right there that I just drew out. Oh, and there's This is an uptrend line. There's a beautiful target. Look at that. It's a confluence of the uptrend line and that 222,654. Very good. It was support right there. Broke down. And so there's if you want to keep it very simple. There's a minimum target, near-term swing target. That's at least 7.5% from where we're at right now. Okay, let me right under the right under the 30-minute mark. Let me get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.